Gold's price doesn't melt up often, but here we are. Gold just keeps punching higher and higher, while silver is starting to catch up and mining stocks are coming along for the ride. But why now? How high can gold and silver run? Are mining stocks worth it? And just what can all of this tell us about the state of the economy? We dive into all of this today. My name is Guy, and whether you're a gold bug or not, this is one video you need to watch. First up though, I'm not a financial advisor, and nothing in this video should be considered financial advice. This is educational content meant to inform you about the precious metals markets and the economy. If that sounds good, hit those like and subscribe buttons, smash that notification bell, and let's get into it. Now, gold's melt-up has been remarkable, but there are good reasons for it. Regarding its most recent price action, rate cut odds are doing a lot of the heavy lifting, with the latest round of weak labour market data meaning a rate cut this month is almost guaranteed. That's been seen across all markets, with every announcement that indicated easier monetary policy. Yields dip, the dollar weakens, and gold goes higher, along with many other assets, including stocks and crypto. And the dollar is worth double-clicking on. The DXY is down materially this year, and that boosts non-yielding assets priced in USD. A weak dollar plus rate cut expectations is basically rocket fuel for gold, which is why its price just keeps going up. Politics are adding a premium too. Ongoing pressure on the Federal Reserve by President Trump has brought Fed independence into question and created a hedge the institution bid for precious metals. When investors doubt the stability of monetary policy independence, they reach for assets perceived to sit outside of politics like gold and silver. On top of that, we also have geopolitics. Conflict risk in multiple regions has pushed portfolios towards safe haven assets, with gold arguably being at the top of the list. That risk of conflict hasn't exactly faded, and it helps explain why gold is in favour right now. And believe it or not, but trade and tariff uncertainty have also kept the hedge impulse alive. The more investors look at the world and see higher frictions and slower global growth, the more they prefer assets that don't depend on cross-border payment rails or corporate earnings. That preference bleeds into both gold ETFs and physical gold bars. To put things into perspective, physically backed gold ETFs just logged their strongest first half inflow since 2020, with roughly 397 tons added. That brought total gold ETF holdings to their highest level since August 2022. Meanwhile, major central banks, almost all of which have gold holdings, have kept buying. Official buying data has run above 1,000 tons per year for 3 straight years, pushing total reserve holdings towards 36,000 tons. Some months are slower, some faster, but the structural bid is intact, and it has increased as questions around the US dollar intensify. On top of all these fundamental drivers, it's also worth noting that a speculative or momentum bid is likely present too. That means there are short-term traders just jumping on board to ride along for some quick profit. That's worth keeping in mind as gold's move has become increasingly vertical. So, where does the gold price go from here? Well, if we look at the technicals, gold consolidated in a roughly $3,300 range between April and August and broke out in September. A straight measured move of that $3,300 range from the previous all-time high of $3,500 would bring gold to $3,830, perfectly attainable within Q4 this year. That sets up a swing at the big round $4,000 number and beyond in the first half of next year. And that's also consistent with some prominent forecasters. Goldman Sachs has gold reaching above $4,000 in the first half of next year if the current factors driving gold's price persist. However, there's an even more bullish scenario for gold, which Goldman Sachs also outlined. If Fed credibility takes another big hit and private portfolios rotate into gold, their maths pushes the target up to between $4,500 and $5,000. That's not their base case, just to be clear, but it is worth keeping in mind as a possibility. And if you're also bullish on gold, but you're not looking to buy tons of the stuff like central banks, you should know that leading crypto exchanges offer tokenized gold. And if you want the best deals for exchanges offering just that, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. And these deals won't be around forever though, so take advantage of them while you can using the link in the description below or the QR code on screen. So, gold is hot right now, and it looks like the heat is slowly spilling over to the second biggest precious metal, silver. Silver has now ripped to 14-year highs above $40 again, largely thanks to a softer dollar and rising rate cut odds. But unlike gold, where most of the demand is monetary, around half of the demand for silver is industrial. That means big industries have a greater need for silver, everything from solar panels to electric vehicles to the smartphone in your pocket. This means that there are two primary drivers of silver's price: speculation and industry. But just like gold, silver's price has seen big jumps recently every single time the dollar weakened or the Fed's credibility was threatened. Notably, silver's summer rally started while gold was still moving sideways in that range we mentioned earlier. But if we zoom out, silver's price has actually been building for the last 2 to 3 years, and there are some solid reasons behind it. Taking a closer look at industrial demand, you'll see the industrial market has been running deficits for years. This summer, the Silver Institute projected another sizable shortfall in 2025, the 5th straight year after a heavy cumulative drawdown of above-ground silver supply since 2021. That's happened while industrial demand stays near recent highs, which keeps any cyclical soft patches from collapsing this core demand thesis, at least right now. In case you didn't know, most silver supply is a byproduct of mining other metals, so higher silver prices don't magically summon new output. And that means deficits in supply aren't refilled as quickly. The financial market flows also line up with the industrial story. Recently, investor interest has rotated from gold into silver. The result is that the largest physical silver investment vehicle, the iShares Silver Trust, now holds over 15,000 tons at the time of shooting. And again, the bid in financial markets is visible on days with headlines around monetary dovishness or questions around Fed independence. Put simply, the reasons why silver is outpacing gold recently are the fact that it's also seen as a safe haven, is getting speculative flows from gold, and has sizable industrial demand propping it all up. And this brings us to an important point: the historical trends between gold and silver. History shows that whenever gold has a bullish trend, silver usually lags early on and then sprints to catch up later. The gold-silver ratio, or GSR, gives us some insight here. At major cycle tops and panics, GSR tends to spike sharply, meaning gold has outperformed silver and silver lags. In 1991, GSR peaked at 106, then slid to the low 40s as silver outperformed. In 2008, it jumped to 88, then fell as low as 30 in 2011. In the 2020 shock, GSR surged above 120, then fell to 62 at the start of 2021. From that level of 62 in 2021, GSR went on a bullish trend and spiked sharply up to 105 last month. Since then, it has fallen into the 80s. And that indicates that silver is currently in a catch-up phase, and it may well continue, especially if traders pile in to make this a more speculative momentum trade. Nothing is guaranteed, but that is what the chart suggests. So, silver is bullish, and we may even be looking at a window of outperformance versus gold. But where would that take silver's price? Well, if we zoom out here, silver's recent move is now ploughing through resistance and making its way towards the 2011 high of just under $50. Ignoring a potential anchor bias here, these levels are a bit like magnets when price is already this close, with silver sitting in the low 40s right now. $50 is the clear target the market has in mind. And that kind of move coming by year end would be massive. But if the demand for precious metals in 2026 shapes up like anything Goldman Sachs expects, then $50 is easily reachable. Now, we can clearly see that gold's price is ripping ever higher, but what about the companies actually mining the stuff? To get a clear picture of miner stock performance, The easiest way is to look at the NYSE Arca Gold Miners Index. We'll just call it the Miners Index going forward. The Miners Index is a cap-weighted basket of the largest publicly traded gold producers. That's the benchmark most investors have in mind when they talk about the gold miners as a group. This month, the Miners Index is printing fresh all-time highs, the first new peak since 2011, which tells you that gold's bullish trend is reflected nicely in miner stocks. Just like gold, miner equities have benefited massively as rate cut odds have risen and economic data has pushed investors to find safe havens. The mechanics here are pretty straightforward. A miner's profit margin is the gold price minus its all-in cost. When gold leaps, that spread widens, so earnings grow faster than the metal. Costs don't stand still though, and they've been the spoiler before. Labour and input inflation pushed costs higher last year and into 2025, which is why you occasionally see miners lag even when the gold price is hot. The difference now is that the gold price has moved far enough to overpower those costs and kick free cash flow back into gear. And how companies manage exposure matters too. During this rally, many miners have held on to their supply because the gold price keeps skyrocketing. That means things are sweet when prices run, but it also means drawdowns sting more as miners could potentially panic sell. Nonetheless, the greater risk appetite here partly explains the vigor behind this miner index rally. And speculative flows are once again backing the fundamentals here. While we're using the miners index as a performance compass, it's worth noting that investor demand is also visible in the wrappers that track it. August alone saw more than $500 million rush into VanEck's Gold Miners ETF, the most since November 2023, a clear sign that allocators are re-rating the space. So, if that didn't make it clear enough, the Miners Index is up about 100% year to date, while gold itself is up around 40%. So, gold miners are widely regarded as a beta play or a leverage bet on gold itself. But be careful, as miner stocks come with unique risks of their own. They're all individual companies managing their own operations with their own risks. Even if you look at the index, it's a global mix. That means you're taking on things like jurisdictional risk, which is why index-level volatility can spike on country-specific news that has nothing to do with gold itself. Just something to keep in mind. But the main takeaway here is that gold miner stocks are seeing a gold rush in this current market dynamic. Yes, pun intended. Okay, now altogether, that's a lot of bullishness. But let's make sure to keep things balanced here and explore how this rally in precious metals could possibly come to an end. First and foremost, the classic spoiler to a gold and silver rally is a stronger dollar and higher bond yields. For example, data that pushes the Fed towards a more hawkish stance would lift the dollar, and precious metals usually take a hit as a result. And we actually saw a glimpse of this on the last upside surprise in inflation back in August. Gold slipped as the dollar and yields popped. Then we have geopolitics. Now, we won't dive into the political and economic state of the world right now, but if global tensions cool off and things start to look more peaceful, then gold and silver lose the safe haven bid that has fueled much of this rally. On that note, it's also important to look at market flows more generally. As mentioned, gold ETFs pulled in the biggest first half haul in 5 years and kept adding throughout August. If that demand falls off or flips, you remove a key pillar that's been absorbing supply and validating higher prices. Another key pillar for gold is the central bank bid. As of right now, central banks are still heavy buyers, but the pace can wobble. While July's net additions were positive, they did slow materially, and the World Gold Council has already trimmed its full-year central bank demand expectations. If central banks step back for a few months, then gold loses a steady buyer. Meanwhile, physical demand is another soft spot, with demand there already showing signs of being tapped out. Some research shows that soaring gold prices have seen jewelry demand fall close to pandemic levels. Silver has its own potential issues as well. Remember, over half of the demand for silver stems from industrial production. While that's great when things are on the rise, a significant growth slowdown would hit silver's price hard. History also shows us that silver can drop on demand worries even when gold holds up. When it comes to miners, meanwhile, they have their own risks. Cost inflation, labour issues, hedging choices, and jurisdictional shifts can break any beta narrative in a hurry, even with spot prices staying near record highs, and especially if bullion prices fall. Times are good right now, but things can flip on a silver dime. Again, pun very much intended. Now, to be clear, times are currently good for holders of gold and silver. But prolonged rallies in safe havens such as these is typically a bad omen for the economy and everyday people. But why is that? Well, when safe havens rally higher for months, it's the market whispering, or shouting, that something's off. As we've discussed, these are factors like weakening currencies, wavering faith in government institutions, or a chaotic geopolitical landscape. One recent tell in this regard has been the split between gold and bonds. Gold is ripping while treasuries remain a bit chaotic, and that's the market's way of saying it wants to hedge political risk first and foremost. Put simply, when safe haven bids persist or intensify, it usually coincides with tougher conditions for the real economy, and we can see that already. To put it mildly, recent data revisions show the US labour market was much weaker than initially stated, and this is while import prices have crept up alongside a softer dollar, all of which squeezes households at the same time. Consumption patterns also provide signals here. Signs of weak retail sales and manufacturing softness have actually been flashing for months. Add in tariff-driven price stickiness and the impact on everyday people can be brutal. But that type of tough economy paired with uncertainty is exactly where gold tends to keep a bid, and silver as well. If allowed to snowball from here, all of those negative factors translate to lower growth ahead. And if gold keeps climbing while growth cools and prices don't, that is simply a terrible sign. It says households will keep feeling squeezed and monetary policy may get boxed in as it struggles to stimulate the economy. But again, that's an environment where bullion tends to thrive. And it's also worth remembering that investors have other options too. Bullion is not the only thing catching a bid as the world sees a big regime shift. Bitcoin is now here, and it has accessible on-ramps now too, with ETFs continuing to soak up coins. Bitcoin ETFs chalked up record 2-day net inflows back in July, while gold chopped around, evidence that the bid for exposure to something outside the system doesn't belong to precious metals alone. Sometimes crypto and precious metals run together when trust wobbles. Other times they diverge as flows chase whatever's moving fastest. Either way though, a durable safe haven rally is rarely the friend of Main Street, even if it feels great for holders. And well, that's about it for today's video. If you're not subscribed to the channel yet, why not? Well, you can do so by smashing that subscribe button right down there. Feel free to give the video a like too while you're at it. And if you want to learn about how crypto might be an even better answer than gold as the world gets crazier, you can watch our video on that right over here. As always, thank you all for watching, and I'll see you again soon. This is Guy, signing off.